term sheets, fundraising, specialty. To me, it's one of the best parts of being a founder. I know a lot of people would not agree with me, but I like it, I enjoy it. I did it during my career. Before I came to SCRA, I did it 5 times, 3 really bad exits, 2 really good ones. So some experience, and we're gonna have a nice chat with Scott and Ryan. These guys have raised, I'm sure, a lot of money. We'll get into it. Lots of questions, but first, raise the hands. Who's raised money and just know it's maybe not fun? Really, that's it? I would think there'd be more, okay. It's fun, it's not fun, it's hard, it's a full-time job. So if anyone thinks it's you raise money trying to do your company or do something else, it is not that way. If you're gonna fundraise and fundraise right, it's a full-time job, and I'll repeat that 10 times, it's a full-time job. So we're gonna talk, and I'm sure you guys can agree with me, Ryan, Scott, that
full-time job.
Let's talk about your journeys. We're gonna start there. How much money have you guys raised for your companies individually? Ryan or Scott, anyone want to go first?
From outside capital for Zylö, it's been $9.3 million.
I believe we're somewhere around 13. We recapped somewhere in there and paid off a lot of things, so I'm not 100% sure.
Okay. When you guys first started, you raised 9, you raised 13. What's the first thing you did when you were going to go start fundraising?
Pitch deck. I mean, well, we had a business idea. We started under a parent, so we have a little unique story. We started under Community Journals Publishing Company, a print media company in the upstate of South Carolina. Maybe important to know is that I run a media company locally, Cola Today, GVL Today, CHS Today, and we were a product innovation of another business. So we were 100% owned by somebody else when we started our company. When we spun out about 2 years into the process, we started raising capital. So we were already generating revenue at the time. While we were in a loss position, we were able to leverage a success story, and we have gotten through MVP, we had customers, so it was a little bit easier to kind of just move straight to pitch deck and start prospecting.
What else in addition to a pitch deck?
Financials, pro forma, all the budgetary things to prove that a lot of it was telling the story.
Right.
And more of it was telling the story and getting people to take a crazy risky bet on us that we actually knew what the hell we were doing than anything else. And I'm even finding that still today, that the story sometimes is more important than the numbers.
Right, agreed.
Yeah, one of the first things you have to do, and it relates to the flyer that got passed around to these tables, is figuring out. We've talked about product market fit a lot today, and there's also a fit with the right type of investor. And you have to know who you're seeking. You can try to go play the field if you want, and that's not a bad strategy. This is a full-time job, remember, but know the tendencies of the various investor types out there. In my history, I used to working in the venture industry. That's all I did. I've probably been involved in 45 rounds of financing on the VC side. I wasn't raising money much of those times. I was on the board with portfolio company startups. But that's what I knew. I know that type of investor very well. But now fast forward to Zylö, and also know that I forged a license with Albert Einstein College of Medicine. So we now have technology, got a business plan and a slide deck, a pitch deck. You got to have that. And my first meeting was a high net worth individual, and this is literally 3 weeks in. And he's up in the Berkshires, west of Boston. He's there with his wife. I brought my wife because we were on the way to the Cape. And 3-hour meeting. The guy grilled me. He was the gruffest guy ever. I thought he had zero interest. And at the end of the meeting, he goes, "Count me in for $500,000. Okay, that's a good start. 2 weeks later, I had a 2-hour meeting with another high net worth individual, and he was in for $400,000. I'm going, hey, maybe this isn't a full-time job. 18 months later was the next yes that I got. 18 months, to the point where 14 months later, everyone in the company had to take a deferred salary program. Okay, so this is the nature of startups. We had Venture South interested. I think we had gotten a little bit of money from SCRA. Thank you, guys. Thank you, Steve, and the board of SC Launch. That helped us going, but I saw the writing on the wall that if everyone had to, I took a 1/3 cut in pay, and the higher you were, the more of a cut in pay you had to take. But that saved our butts. Venture South had told me, we're interested, but until you get to a $2 million total, excluding the first $900,000, we're not putting a dime in. So I had to keep them interested, run around trying to find other people interested, till I had a $2 million commitment, and only then did we raise money again 18 months later after that very good first month that I had. But it is hard, and you got to know what type of investor is good for your company and good for your longer-term financing plan. And that's when people have mentioned it before as well, having good lawyers, knowing what these other, knowing how seed to Series A to Series B, how that all works. And the other thing I'm going to say early on is don't be greedy. As they say in the capital markets, bulls have some success and some good years, bad years. Bears have good years, bad years. Pigs get slaughtered. So it's an old adage that if you get greedy, you're oftentimes going to end up getting slaughtered. So, spread the wealth, spread the ownership in the company.
Leads me to the next question then. So as you prepare an investment thesis, tell me about your investment thesis, Ryan, what you guys did. Was there an average check size? Did you guys research who you wanted to take money from, who you wanted to partner with? How many investors did you want on your cap? Did you tell us about that investment thesis?
I think one of the most interesting things about the investment thesis is that I didn't know what an investment thesis was. Very transparently, I came out of the manufacturer. I'm a mechanical engineer. I didn't go to school to be an entrepreneur. I never took an entrepreneurial class in my life. I don't really read books, which I got made fun of for on Twitter by a bunch of journalists one time, since I'm in the media space, and it was not my area of expertise. And so when we went out, the research that I do is online. And so I started reading, this is how you raise money, and there's the friends and family, and there's these angel investor things, whatever those are, and then there's this VC process. And so I just made a list of all what I believed were high net worth individuals in Greenville, South Carolina, that I had some sort of first or second hand relationship with, and I started reaching out to them, learned pretty quickly a lot, and then kind of figured out what I was going to do. And so one of the things I learned about in that process by accident was the South Carolina Angel Investor Tax Credits. What I also knew is that I did not own enough of my own company to be willing to take dilution. So we had an interesting process in the beginning where we were raising capital with promissory notes solely in the beginning on a 3-year term payable at maturity and taking advantage of tax credits to get people to buy into what we were doing. So we did not have a dilutive fundraising event initially. We raised $750,000 between 3 different parties, one of them actually being Venture South, just a little bit out of scope for Venture South at the time. And that was step one. We really didn't go into an equity round. That was in 2018. We didn't have our first equity round until 2021. So we raised promissory. Then we bought a company using a safe. That's where I learned what a safe was. From a guy in Chattanooga when we acquired a company called Nuga.com. He gave us $250,000 in a safe. $100,000 of that was the value of their company that we bought with no cash, basically. And then we raised in convertible notes, which is where I learned about equity. That was probably in 2020. Then we did an equity round. So not everyone necessarily knows what they're doing when they're building the company, and I was one of those people for a while. Today I know way more than I want to about all of the space, but I learned a lot of it kind of as we went. But I did know that because of the ownership position, I have a co-founder. We started under a parent company, so initially we both owned 0%, then we both owned a small percent, and then going out and doing an equity round was not gonna be in our personal best interest. So, and the company wasn't fundable, because we were literally 70% owned by the parent company at that point in time. And so we had a very interesting road in how we went to balance our cap table over time, and some stuff that's all been amazingly handled now, but we just really didn't know the right way. And South Carolina angel investor tax credits, promissory and convertible and safes was really the right route for us, but it still didn't place the valuation on the business. It was pretty interesting time for us.
Awesome. When did the valuation come in the 2021 round?
Yeah, in January of 2021, we had about $1.5 million payable on various notes, and we raised 1.5 of new money on a 7.5 pre, and we converted in all of the debt that I had been amassing because I didn't have necessarily a defined strategy. So we converted in we actually ended up converting in most of the promissory. We paid off some of the promissory. We converted in the convertible. We converted in the safes. We raised some new capital. It was basically a cleanup round. And in all of that, Community Journals, the parent, took the full dilution and balanced the cap table at the same time. So my business partner and I they gave shares back to the company that we purchased in a post-money 409A valuation. So it was a really interesting way for us to clean up the structure. All of that may sound super confusing to some of you. It was super confusing to me, very candidly, but we really learned and got our company in a fundable position going forward. So we then had the opportunity to pursue angel funding and VC, which we're doing actively in a Series A right now.
So the message is to everybody, follow that path. Right.
We preserved a large portion of the equity of our business, but it was not an easy road. And you talk about funding cycles being maybe every 12 to 18 months or so. I mean, our funding cycle was like every 12 to 18 days. It felt like sometimes. Wow. And so we were constantly raising, and that's a bit of a challenge when you're going angel versus the VC route, is that some of the longevity, the support, the strategy, the planning is a little bit different in some of the support structure around that versus taking a larger check and diluting your company from a VC firm. So it was an interesting road.
You learned a lot. That's the most important thing.
Yeah.
Scott, you want to talk about your investment thesis?
Yeah. Again, we've had two rounds. So what I described before was the A round. The B round actually had sort of a similar start, where a guy that I had met from some other investment in real estate had heard me talk about Zylö, and he came in with his wife, and we spent, again, another 3-hour meeting, and this is summer of, what year are we in? Summer of 2021. 3-hour meeting again, and he walked out and said, count us in for $500,000. So, and by the way, this story is meaningful in that angels are different than angel groups. What I described as an angel, a true angel, sometimes they want to get very involved in your company, because if a lot of times these software, people who made money in software previously, sold the business for many millions, will want to get involved as an angel investor in other software companies because they know how they can really help. That's a wonderful type of angel to get on your team if you get along with that person, right? Because they're going to want to basically tell you what to do. But these angels typically, the true angels, they usually have a net worth that's quite high. They make 3-hour decisions. $500,000 isn't that much to them. B, they have confidence in their ability to size up a person and a technology. And my guess is it's the person more than the technology for a lot of them. And that's what they do. And so there was no term sheet. there was no understanding about what that money even meant for this last guy. But it was a heck of a start for the Series B. And what we decided to do, so typically you have a lead, right? Most every good round, you need a lead, or you're better off with a lead investor, because the lead investor will generally set the terms, okay? Otherwise, you're making it up, and these other people who are coming behind the lead want to go, well, who set the price? The price is super important, because from that price, and it's like buy low, sell high. From that price, it sets the multiple that you're going to get if it's successful. So Venture South ended up being our lead in our A round, and they set the terms. So what I decided to do here is I worked with this guy who didn't know what a term sheet was. And I said, hey, you're going to learn a lot here in the next couple months if you're willing to play lead. And he said he was. I said, you'll get a board seat from this. And I helped him write a term sheet. And then while we were doing this, we had 3 other people come in, 300,000, 100,000, 100,000. So we now had a lead of $1 million from 5 people, none of whom knew what a lead or a term sheet was. So, but we worked with them as a lead syndicate now, and I ended up working with that one guy who had a master's in mechanical engineering, so he was a smart guy, and we ended up writing a due diligence paper. So again, people who are following are going to want to see a term sheet that has a reasonable price, that's not being too greedy, at least on the part of the company, and would prefer to see a due diligence document. This is the way the VC world works. But Venture South has a due diligence document. They work on that at great length. And so that's how we started off our Series B, and ended up having multiple closings, which is you can get away with if it's outside of the VC world. VC world would never, ever, ever allow any of what I just mentioned, and a lot of investors wouldn't allow anything that he mentioned. But it worked for them. He found a way. It had some risks, because taking on a lot of debt is dangerous. Talk to a Vidium out of Asheville, right? They went BK, a successful company that ended up going BK because of too much debt. But they navigated their way through it with a successful outcome, so it was a good fit for them. For us, the way we did it was a good fit for us. Companies I was with in San Diego on the West Coast, it was always the VC route, because these were kind of big technologies that could be billion-dollar companies someday. And when you have that type of idea, VCs can be an excellent fit.
So now we understand you need a pitch deck, right? First to start. Then you got an investment thesis, who you're going to go call and ask for money from. Now the third step is now you're in a meeting with an angel group, high net worth investor, institutional investor. Tell us how that meeting runs. Do you pitch? Do you tell a story? Focus on that. Now you're in the room with them.
I'm pretty sure that I've pitched the company 1,000 times now, probably.
Right.
I'm literally currently out with my prospecting list has 300 or so people that I'm going after. So like literally by Friday, I'll have emailed about 300 of my prospects for our Series A right now, which means that for the next 30 days, I'll probably be in like some of those meetings, like maybe I'll get 100 meetings out of it, right, over the next 30 days, which is insane. And you pitch and pitch and pitch and pitch. And so you typically, a lot of the times in these situations, you aren't necessarily talking to the decision maker first. So I'm talking to some analyst at some VC firm. I know that my thesis aligns with their investment thesis. In this circumstance, I am very well, like the folks that we've gone after align with our industry, with our investment thesis, with everything that we want. Now it's a matter of it's like dating. It's like trying to get them to, like, hey, I'm right here. Pay attention to me. Will you actually have the call? Will the analyst actually pass in the Monday meeting? By the way, a lot of their meetings are on Mondays where they like review the people they talked to the week prior and get back to me and want to have another meeting and then share the data room. Are we, for my space, if it's a competitor who's potentially the investor, we have an NDA process. So I'm a media company. If Barstool or BuzzFeed or Vox or whoever wants to invest in us, we have to do some additional diligence. The data room is built out with every single thing under the sun about our company you could possibly think of. And then after every single meeting I have, I always get asked questions, and that builds my diligence deck. So I have a pitch deck, and then I have a secondary deck that answers in a visual format every question that I get answered in every single pitch. My deck has probably been revised 1,000+ times since I started, and it iterates now usually every single day through the entire process to continue to answer the diligence questions that we get asked. So it's a pretty robust process, and then from there, assuming that we secure the lead, then we are negotiating the term sheet for a period of time. There's additional and final diligence that'll happen before we get to closing. And then depending on the circumstance of your raise, we're not just necessarily seeking equity, we're looking at a little bit of a recap. So we have some additional negotiating points that will come into play too in our diligence here. So it is a highly complicated process and it is not fast. And it requires a full-time job. I just talked about having 100 meetings in 30 days. I don't have time to have 2 meetings in the next 30 days. So it's a massive evolution of my day-to-day responsibilities in the company to be in a fundraise.
Thank you.
I'm with you every step of the way. I've had, you've got to continue to improve your slide deck. If people seem confused by a slide, figure out why they're confused and change it. And it's, practically a full-time job. It's usually 30 to 60% of my work week when we're in fundraising mode. Due diligence is hugely important. A lot of times with these angel groups, you pitch, oh, by the way, I need to have 1,000 iterations of a 3-minute pitch, a 5-minute pitch, a 7-minute pitch, a 10-minute pitch. They all give you a different number of minutes. And sometimes it's 3 minutes on the first round when it's a committee, and the second round it's an 8-minute, pitch. And, so you're always changing that as well. But due diligence. So you're gonna, get used to hearing no, because you're gonna hear no a lot. You're gonna hear a lot of grouchy people who don't like A, B, or C. But the data room is perhaps your most important tool. If you have a well-organized data room, which takes upkeep, by the way, because your world as a startup is changing every week. So have good professional documents in your data room, because other than your technology, your team, and that's been stressed a lot today, hire people that are the best. The VCs won't let you hire anyone but the best, by the way. They know how to do it, and they will veto people who are not the best. And they'll pay for them, too. That's the good part about being with the VCs. But all that stuff is a lot of work, but you got to be on your toes. You have to get good at answering the tough questions. The only other thing I should bring up on this, on the due diligence, again, it's the difference between a VC and angel groups, with all due respect to angel groups. But in our Series A, we just started the company a year ago, I am getting grilled about my exit strategy. And I grew up in the VC world where, you're in your first year or two, that's not a thing. If you perform and hit milestones, there will be exits. That's you don't have to worry about that. But in our Series A, we're getting grilled about, come on, we want a 10x return in 3 years. And I would tell these guys, I don't feel comfortable promising that. It happens, but it doesn't happen very often. And, we were still learning our technology, at that point in time. So, but angel groups will, I got better at answering that question, by the way, because I got a lot of feedback about how that was not the right answer, Scott. So I had to fine-tune that element of my presentation. But you have to work at it. You have to practice. You have to work at it. You have to work with your team on what's a good answer. And you have to work your team. We had a product development, our head scientist. He's the most pessimistic guy ever. And, you put him in front of people and they want someone who's encouraging, can lead them to the promised land, and your naysayer isn't a good part of that equation.
So now, got a deck, got an investment thesis, you go through and do your pitch, which is your storytelling. You got a good data room, they do due diligence. Now it's the time of, we're ready to do a term sheet with you. So, term sheet. Do you use their term sheet? Do you like your term sheet? Do you try and do a term sheet on your own to save legal bills or cost? Or do you hire legal to work in tandem with you? What did you guys do?
I think it depends where you are. Where you created your own, I think, is interesting, really interesting, like awesome, potentially. For our Series A, we actually made our ideal term sheet with our legal counsel, which I literally think is on your socks right now.
Yeah.
Our legal counsel's name,
Yes.
Which is wild. But we drafted our own term sheet for the purpose of knowing what we wanted in our round.
Okay.
Not necessarily that we were going to present that term sheet to the prospective investor unless we identify an investor that is advantageous to us in.
Okay.
So a lot of the preparatory work around the term sheet is knowing what you want in it. We're trying to carry forward our Series Seed terms pretty one-to-one into this Series A round. One of the things right now that's concerning is, as macroeconomics and other factors are evolving, how our terms and term sheets changing. So it's really a matter of knowing what you want, and knowing what you want comes back to our legal counsel was probably the best guidance that we got. We don't need someone to run our round and teach us everything, but if you have really good legal counsel, they do a lot of that work and education for you. And so once you get term sheet in hand, depending on who it is, negotiations can be very, if you've talked about it a lot before the term sheet hits your desk, it's pretty on point. If you don't, you're going to have a lot more time back and forth, which could derail your deal.
So did you guys talk about some of the terms during your pitch?
Or
due diligence?
I'm pretty upfront,
Okay.
at this point on what we're trying to get, even in my initial with the analyst. I mean, from day one, today we know exactly what we want.
Got it.
There are certain questions, though, I went back. I have about 6 advisors that I go to locally in South Carolina and talk about what we want. And half of them are like, put out the number, tell them how much you want. Do I want to raise $5 million or $10 million, or do I say 5 to 10? And do I say I'm raising it at a $40 million pre-money, or do I say it at 55 post? And they all have the opposite answers of each other, which is not helpful. I mean, it's helpful, but it's you still at the end of the day have to make a decision and go in. So there are certain things I don't share and certain things that we do share. And certain things that we kind of read the room and identify what the investor's comfortable with. With doing a little bit of a recap, it's a little bit of a unique situation where I might be more comfortable yielding on valuation versus other terms. But the more you understand all of it, the easier it is to talk to the things that you know they're going to care about. I know I sure as hell don't want a 2x liquidation preference. I mean, there's certain things that I know I'm not going to, that we've identified that we're going to hold the line on, but also depending on where your company is in its own maturity, you can or cannot hold the line on certain things, and you have to be willing to know where are you willing to flex in the term sheet negotiation.
Okay, fair enough.
Yeah, again, my past, I created a lot of term sheets because I was investor and then I was on the board, and sometimes we would do what Ryan was talking about, kind of this is our ideal term sheet, and you could then use it as a guide in answering questions during meetings with VCs and the like. But if you all are thinking about raising money, you need to know that the price per share, which defines your pre-money valuation, and the amount you raise, which then combined with the pre-money will define your post-money valuation. Liquidation preference, he mentioned that, and 2x. You need to know all that stuff because price is 1/4 of the equation of a term sheet, and about that important too. Board seats, which leads to board control, and is it going to be and who gets to select the independent board seats. Liquidation preference is hugely important, and you need someone good, a good attorney or someone who knows cap tables and term sheets, to explain what that really means and what that means to your employees. This all trickles down to your employees and the value of their stock options down the road. So you need to know all that stuff. In order to, when you go into negotiations about these things. And there are all these other things. There's ratchet rights and all these protections that the new investors coming in are going to try to get. And some of them are normal and standard. 2x is something you do not want, a 2x liquidation preference, because in a middle scenario, on a decision tree, you got your upside scenarios, a lot of that stuff doesn't matter. Everyone's going to make a bunch of money. But in the middle and downside scenarios, all this other stuff is super important. So make sure you go into these things well informed.
So now you got a pitch deck, now you got a data room, now you got an investment thesis. You tell your story, go through due diligence, get your term sheet, you get your money in the bank. You start rolling. Company does well, maybe it doesn't do well. You need a little bit more funding. Have you guys been through that?
And we're definitely in a bridge right now.
What's your strategy?
there's a couple things that trigger that. So one, when you're raising money, I think it's always true, everyone's like, you should raise more than you need because you always need more than you think you need. Or you have, like in our instance, we actually had great success. We tripled the size of our company last year, which is amazing, but it came at a challenging time. We grew our company during COVID, macroeconomic challenges, changes to the advertising industry. People cost more money on the West Coast than they do on the East Coast, surprise, surprise. Like a lot more. Salespeople were hard to get, and so things cost more than we thought. Well, that means that we're going to burn through the money that we raised a lot faster. So we made that decision to do such, but now we have to fill that gap. So there are different other levers that you can pull to get yourself from literally where we are today. I need to make sure that I have enough dry powder in the bank to sustain the business until we get through the A round. Right. So you make those terms favorable to other investors, which is what we've done through our relationship with Venture South and angel investors that we work with. That puts enough money in the piggy bank and gets us across the finish line. But that's its own challenge. And then putting the actually money you raised to work, that's when the real work starts anyway.
Right, right.
Yeah.
Scott?
Yeah, we just raised our Series B about a year ago, $5.3 million. The other way we've raised money is non-dilutively through grants. We're up to close to $4 million now, and a little bit of that came from SCRA. They have a grant program for those interested. But it mostly came from NIH and DoD grants. That's the good news. The bad news is that gets us close to an IND, an investigational new drug application. And so we're the classic tale of two cities where we sold all of our investors on the non-RX, non-FDA applications of our technology. Because all of our investors asked us specifically, well, you're not going to be dealing with the FDA, are you? We go, oh, no. And if we do, it'll be through grants, and it won't it won't dilute you. Well, we're getting to that point where once you file an IND, that's when the big money starts. I mean, by the millions, if not $5-10 million at a time. And our investors didn't sign up for that. So we're actually thinking of splitting the company, doing a spin out of the RX applications, but because that's when you need VCs who are highly specialized, who are used to dealing with the FDA and raising $10-20 million at a time. So that's where that's a tough thing to do, by the way, because there's a lot of difficult decisions to make with a spin out. And it's a taxable event, so thank you, IRS, for that. It shouldn't be taxable, but it happens to be one of those things. So that's where we are.
Okay, so now everyone knows how to go and raise money. Is that right? Gentlemen, I want to thank you both, and thank you all for your patience.